yields are going to keep punching upwards because of the amount of debt that needs to be sold. And I think you can see that already in the US system, where the rising yields pretty much since the summer or late summer has had absolutely nothing to do with inflation expectations, nor anything to do with the pace of the economy. It's everything to do with basically supply and demand in the market. There's a lack of buyers generally, or let's say there's a lack of traditional buyers, and what you're getting is a big increase in coupon supply. And that is a major issue for the authorities to tackle. What it will mean ultimately is they've either got to play a few tricks, which I think they're basically doing right now anyway. But more particularly, the Federal Reserve has got to come in and buy more debt. In other words, you're going back to QE. They won't call it QE. They'll call it something else like quantitative support for markets, not quantitative easing. But this is the name of the game. I mean, the numbers are just too big here. You can't rely on the private sector to take up all this supply, particularly when a big constituency, which is foreign investors, are plainly losing their appetite for US debt. The Chinese are very deliberately running down their holdings. The Japanese are not buying in the way that they bought before. And with foreigners owning something like a third of US debt, still, I mean, this is a big constituency to worry about.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Howell, who's founder and managing director of CrossBorder Capital. So, Michael, thanks so much for coming back on the podcast today.
Great pleasure, Anthony. Good to be here.
I'm looking forward to our conversation because, yeah, it seems like a little bit of change in, I guess, the liquidity space since we last spoke around April and March. So, I guess from your perspective, what are you currently seeing in global liquidity?
Well, I think the answer is that it's broadly flatlining. It's not really contracting to any great significance. I think that pretty much explains what markets are doing. If you look at generally risk assets, take the S&P as a good benchmark. The S&P is pretty much in a ranging pattern. I think that's consistent with what the liquidity numbers are basically saying. That I think is going to be a pause. I mean, I think next year is going to be a year of probably greater liquidity. The problem right now is that the fixed income markets, which provide a lot of collateral for credit providers, are misbehaving quite badly. So yields pushing up, the value of collateral is consequently going down. In other words, the value of bonds that are posted against loans are going down in value, which means that the ability to borrow against that is compromised. And as a result of that, liquidity is not coming through in the way that maybe it had done 6 months earlier. Now, this is not to say that central banks are reducing liquidity. They're not. The Federal Reserve at least is sort of inching its liquidity injections up. I mean, I'm not going to say that it's pouring liquidity into the system. That clearly isn't true. But it's flatlining its liquidity injections. It's trying to support the US banking system with cash. But more importantly, if you look at China, which is the other key player in the system, China is going for it. It's pushing a lot of liquidity into markets. In the period since the early October week holiday in China, the sort of golden week period as it was called, the authorities have actually come back and pushed a lot more cash back into markets. There was a big injection before the holiday, but it's basically persisted. And it seems that this is a clear and deliberate policy change by China now. And you've got to look at what the People's Bank is doing in terms of its liquidity thrust that's going ahead. It's not about interest rates in China. It never has been. It's all about the flow of liquidity.
Okay, that makes sense. So if we focus on the US to start with, Powell sort of came out yesterday talking about how he'll let the bond markets, I guess, take control of what's happening. So I guess from your perspective, do you think that's the right policy that they're following? And do you think the bond markets will? Yeah.
I think it's brave words, but the reality is going to be very different. I mean, he can't let the bond markets take control. The authorities have got to try and control the bond markets. And I think this is another way of saying what, to use an acronym, this is YCC or yield curve control. This is what they need to implement. All central banks and finance ministers are going to have to go down this road at some stage. The debt burdens that the West in general faces, but the US faces specifically, are of eye-watering magnitude. And essentially, unless something changes, yields are going to keep punching upwards because of the amount of debt that needs to be sold. And I think you can see that already in the US system, where the rising yields pretty much since the summer or late summer has had absolutely nothing to do with inflation expectations, nor anything to do with the pace of the economy. It's everything to do with basically supply and demand in the market. There's a lack of buyers generally, or let's say there's a lack of traditional buyers, and what you're getting is a big increase in coupon supply. And that is a major issue for the authorities to tackle. What it will mean ultimately is they've either got to play a few tricks, which I think they're basically doing right now anyway, but more particularly, the Federal Reserve has got to come in and buy more debt. In other words, you're going back to QE. They won't call it QE. They'll call it something else like quantitative support for markets, not quantitative easing. But this is the name of the game. I mean, the numbers are just too big here. You can't rely on the private sector to take up all this supply, particularly when a big constituency, which is foreign investors, are plainly losing their appetite for US debt. The Chinese are very deliberately running down their holdings. The Japanese are not buying in the way that they bought before. And with foreigners owning something like a third of US debt, still, I mean, this is a big constituency to worry about.
Did you see sort of the Fed doing what the BOJ have done recently? Is that sort of the end game for it?
Well, I think you've got to think broadly and generically, and the answer is they'll do something, they'll fashion something similar. It won't be exactly the same. They won't be targeting the 10-year yield in the way that the Japanese explicitly did through buying, but there'll be other factors. I mean, the Federal Reserve is already talking about, or the Treasury rather, is already talking about doing Treasury buybacks next year. That basically means that they will buy what are called stale or off-the-run issues, and they'll replace them with similar bonds of similar duration but are freshly issued. Now, bizarrely, that actually means that they can sell those bonds for a higher price. So the market's not purely as efficient as claimed. But why should they need to do that in a market which is, on the face of it, supposed to be the biggest and deepest and most liquid market, financial market worldwide? I mean, it's a head-scratching moment. Why are they doing this? And basically, they're trying to improve liquidity in the markets. What are they also doing? They're basically forcing the reverse repo tranche, which is a pool of, if you like, stagnant money at the Federal Reserve, non-circulating cash held on the Federal Reserve balance sheet, which is basically money of mutual funds or banks that's held there. They're forcing that back into circulation by targeting these funds directly with Treasury bills. And if you look at the scale of the decline in this reverse repo tranche, again, it's very significant. It means that they can basically issue coupon debt without too many worries about liquidity in the system. Liquidity is improving because of that rechanneling of funds back into the system. So there's a lot of manipulation currently going on behind the scenes. And you've just got to look at the level of US bank reserves and just note the fact, as we've been suggesting for a long time now, that ever since the September 2022 UK gilt crisis, US bank reserves have absolutely flatlined. Now, if that's not, if it's yellow and quacks, it's normally a duck. And this looks like, in finance speak, a duck.
Do you think they'll have to bring in sort of more financial repression? So I guess forcing pension funds and banks and other people to have a higher percentage of government bonds?
Well, I think I think the answer is that that is probably coming in some form. Whether you actually get through, whether you actually get that legislation or that direct, those direct measures, I'm not certain. I mean, there's clearly a lot of talk right now of a Basel IV. Basel III has been the legislation enacted internationally, which basically compels banks to hold more liquid assets and greater capital buffers. That's been one of the factors that's actually driven the dollar up and has encouraged a huge move into US financial assets in the last decade. And the talk is there'll be a Basel IV of some form, which will basically reinforce the Basel III measures. So that could be something that transpires for sure. It may well be that pension funds are encouraged to hold more debt, but actually the arithmetic of pension funds means that they're holding more debt anyway, for the simple reason that many of these schemes in America and in Europe are reaching or closer to maturity. So the profile anyway is going to be higher debt holdings. Now, I think the other fact I think to note in all this, which is somewhat arguing against the need for an explicit financial repression, is just look at the flows into bond funds right now. And what you're getting, despite, as I say, despite the big losses that bond funds have taken, the huge flow of money, particularly of US investors in bond funds, is actually quite dramatic. And it's suggesting that carry at the front end of yield curves is actually very attractive to investors. I mean, if you can get, you're picking up 5% in US dollar terms, effectively risk-free, or if you want to go for the index-linked bonds in the US, you can get now pretty much 2.5% inflation risk-free, which is actually, a remarkably attractive investment on medium-term view. So it may be that you don't need that financial repression. Already you're seeing these flows. So what I'm really saying is the lesson here is that maybe interest rates have to stay higher for much, much, much longer than people are thinking. But I think to reinforce that picture, the Federal Reserve has got to come in and buy more, because otherwise, if money is going into bond funds, it's not going anywhere else. It's not going to the equity market or more productive investment schemes. So I think the Federal Reserve has got to come in and support it.
Yeah, it makes sense. I guess if we look at more long-dated bonds, as you said, they've had quite a drawdown over the past few years with increasing yields. What impact has that had on sort of, I guess, collateral markets and what people need to provide collateral?
It's had a negative effect on collateral markets, because basically, if you look at most lending now, one has to post collateral against a loan that's taken out. And you could say, generally, think of the US Treasury bond as really as the sort of pristine measure of pristine collateral. That has fallen in price quite significantly, not only this year but also last year as well. So you're looking at maybe the biggest bond rout that one's seen in the post-war period. So this clearly has an effect, and it's not. I mean, I'd be misleading to say this is not bearish for liquidity, because clearly it is. It's having a detrimental effect. But the fact is, we're probably reaching somewhere near the peak of bond yields right now. And I say that simply because, you're at levels where even if yields punched up another 100 basis points, given the carry that you've got on the bond markets, bond investors would be breaking even and not losing, even with a higher an increase in yields. In other words, the capital loss would be offset by the 5% coupon that you're getting on the bond. So we're at those sort of levels now. So I would suggest, from a risk return point of view, bonds are looking, a lot more attractive than they were 2 years ago. And in fact, for the first time in 2 years, we're recommending fixed income again. And I think, look at 2024, the celebrated 60-40 asset allocation mix between equities and bonds, I think is going to come back into favor. I don't think that's a great long-term investment, but I think for a 1 year view, it's not bad.
Yeah, that's really interesting. So I guess, do you see there's the potential for another risk of, if we look at what happened in the banking crisis this year, a lot of the some of the banks had to sell their bond portfolios at a loss. They have to realize those losses. So do you see there's a potential for that maybe occurring for the people who've actually been holding the back and holding these longer term bonds, or do you not think that could be an issue?
I don't think that's so much of a risk now. I think it was clearly a risk earlier on this year. I think the Federal Reserve is in there and it understands the problem. I would be staggered if Fed officials are not in US or crawling all over US regional banks to try and work out the full scale of the problem. The Bank Term Funding Program, which is basically a way of alleviating pressure on banks, which means that a bank in the US, if it is suffering losses on their bond holdings, can actually put that back to the Fed and sell it at par. In other words, they don't have to realize those losses. They're redeem the bond at they bought it for 1,000, they're going to redeem it at 1,000. That would that program probably will have to be extended, but it's been very effective so far. So I think that that is much less of an issue. I think that this is not. I mean, let me say this: I don't think this is a 2008 situation, because I don't think you've got the same leverage in the international system that you saw in 2008. Well, in fact, I know you haven't got the leverage in the international system. It's a moot point to what extent there's leverage in the US system specifically, because there may well be a lot of hidden bodies out there, particularly in the private equity space. But I think the fact is that unlike 2008, the maturity wall when all these debts are coming to fruition is very extended. It's maybe 2 years out. It's not 2 weeks or 2 months out, which is really the problem in 2008. So it's a different type of problem. This is much less a credit crisis and much more a duration crisis. But I think where duration is a problem, the Federal Reserve is actually coming in to support it. I mean, my point is that it's not the fact that the Federal Reserve has got its eye off the ball. It's got its eye on the ball, but the ball is getting bigger, and maybe the Federal Reserve is going to have to put a lot more liquidity to work in coming years. And I think that's the reality of the maths behind the sort of the fiscal problems in the US, etc.
Is that just going to be the case that moving forward, things are going to have to be bigger and bigger and bigger?
Yeah, I think absolutely right, because the fact is that the financial system is growing, debt is growing, and what you always need is more liquidity to support debt, and that's the reality out there. I mean, let me show you some slides, and then we can sort of focus in on this. So if you take a look at this slide I've put up on the screen, this is looking at the debt burden that the US economy is slated to face in the next 20, 30 years. I mean, this is projections out to 2050. And the orange line on the chart is basically showing the debt GDP ratio for the US. The gray band is on the right-hand side is projections. Those projections are made by the Congressional Budget Office in the US, which is a bipartisan body. So it's supposedly apolitical, independent of politics. And what that is showing is a very significant increase in the debt GDP ratio of the US. Now, what we've done by comparison is to look at the UK over the same period, or partly of the same period. The dotted line peaks at over 250% just after World War II. The period of decline in that ratio was a period where the UK economy declined relatively. It was a very bad period for the British economy those years, as the history books attest. And the worry is that the US is basically going through the same sort of cycle. Now, increasing debt is clearly not good. And if you take a look at this following slide, what it shows is the prospective coupon supply in the US market over the next few years. This only goes out to 2025. But you can see that this chart is sort of an exponential chart almost. The black line is showing the amount of debt in terms of billions of US dollars that is slated to be issued by the US Treasury. And this is only coupons. This is not Treasury bills. So that's another, 5 trillion on top of that. And then what we put alongside is what the Federal Reserve is likely to do on their numbers, on their assessments, in terms of their balance sheet or net liquidity injections into the system. Now, the Federal Reserve has clearly been a supporter of the US debt markets, but you can see that on the numbers that we've projected there, according to their policy, what you're likely to see is a minimal uptake of debt by the Federal Reserve. I think that's wrong. That's got to increase significantly, and that's really the challenge that's out there. Now, if we go on and look at this chart, which is explaining why interest rates may well be elevated for some time, this is looking at a somewhat wonkish concept called the term premia. Now, the term premia is the extra amount that the bond market has to absorb in terms of yield to basically support new issues or supply and demand within the market. So if you get a lot of extra supply of debt, this term premia will actually be rising. In other words, it will be higher. The black line on the chart will go up rather than go down. And what we've seen in the last decade or so is a significant collapse in the term premia. The reason that's occurred is that basically there's been big appetite for US debt coming out of the global financial crisis because US debt was deemed to be safe assets for many, many banks worldwide. Now, the point is, or my point is, that many of these international banks have been stuffed full of US treasuries already. Their appetite to buy is now much diminished. And looking forward, what you've got is a lack of new buyers, and you've also got the prospect of huge increases in supply. And the orange line is showing the prospective year-on-year growth rate of supply, where the effective stock of US debt is growing at just over 10%. Now, what that means is that the black line, the term premium, has got to rise. So if you put that into sort of dollars and cents, what it really means is you've got to have another 100 basis points, probably, on US bond yields. Now, there'll be a little bit of give because probably policy rates, Fed funds may be cut, but you get the idea that rates are going to remain elevated. Now, on top of that, what you've also got is to look at these next two charts, which sort of frames the problem, I think, quite well, the challenge quite well. At the margin, what you're seeing is the US dollar, or more particularly US treasuries, are not the marginal safe asset anymore, which is what I just alluded to. And this chart is looking at official US gold reserves, which is the red line, which runs horizontally on the top, which is just over 8,000 tons of gold, which is held at Fort Knox. And the orange line, which is looking at the holdings of gold by the BRIC economies, Brazil, Russia, India, China, South Africa, plus their friends who want to get into that club, including what's called the Shanghai Cooperation Organization. And those countries have now got, or now hold, more physical gold than the US. So in other words, what's going on is that these countries are not buying so many US dollar treasury bonds to hold in their foreign exchange reserves. They are buying gold, and they're buying more and more gold. So this is clearly a challenge, because if they're buying gold, they're not buying treasuries, and the US needs to sell more. Now, this chart is one that then therefore needs to be looked at pretty closely, which is the projections that the Congressional Budget Office is basically making about what level of debt the US Federal Reserve needs to buy to stabilize the system. Now, for those people that think that quantitative tightening is going to go on forever, then this chart will disabuse you, because what it basically shows is, even on Congressional Budget Office projections, which are the orange bars there, the amount of debt that is held by the Federal Reserve, in other words, how much US Treasury debt is monetized, put it another way, by the Federal Reserve, is shown in orange. And that starts to go up significantly. And if you want to know what the true Federal Reserve balance sheet size is, just add 2 trillion to those numbers and you get pretty much what the balance sheet will be. The gray bars are our estimates of what is a more likely scenario. Now, what we haven't done is to tamper with the Medicare and Social Security and etc. Programs and say they're too low. We've taken the CBO numbers as gospel. Even those may be too conservative. What we've said is, look, it seems unlikely that defense spending will be as low as is being projected, given the geopolitical tensions. And if you raise US defense spending to a more reasonable 5% of GDP, which is what we've done, you get the gray bars there. And the percentages above each bar show the growth rate of the Federal Reserve balance sheet over each of those years. So you're back into double-digit growth in the balance sheet quite quickly. And that's the challenge you've got. Now, if I then go back to an earlier chart and I show you this particular slide, then you can see, maybe in context, why the global liquidity picture is getting, hopefully, a lot better in the medium term. And what this is showing is a track of global liquidity going all the way back to 1970. The black line is our estimates of the liquidity cycle. The dotted red line is basically a sine wave that we put on top of that. To emphasize that we haven't cheated in this, we basically estimated that about 20 years ago, and it's been run on ever since. So it was, if you like, overlaid on the 1970 to 2000 data, but actually the cycles that you see subsequently are actually true projections. And what this shows is that the cycle seems to be about 6-7 years in length. And what you've got is a dotted line projection that would suggest that you're likely to see a peak sometime around 2026. Now, neatly, the cycle bottomed pretty much on cue in around the end of the third quarter of 2022. The trigger was the British gilt debacle, which was a wake-up call for central banks worldwide. It put the Fed on alert. The Fed stopped tightening in as aggressively as it had been. It began to feed more reserves back into the US banking system. The SVB, Silicon Valley Bank, CSFB, etc., failures in February, March of this year was a further fillip to that liquidity injection, and the curve has been rising pretty much ever since. Now it's a slow burn, but it's going up, and trees obviously don't grow to the sky, so there'll be a cyclical dip at some stage. But ultimately, we think we can get to 2026, and it won't be a straight line up, but the direction of travel is clearly from the bottom towards the top, and that I think is very encouraging. Now, it's not only the US that is doing this. As I said right at the beginning, you've also got to factor in what China is doing. And I'm going to, first of all, show you this chart, which is basically as a foretaste of that, looking at a heat map of all central banks. Now, the heat map, which basically runs from 2021 through to 2023, is basically showing where you got the most significant tightening by central banks. So each one of these lines represents a central bank. There are, I think, 75 or 80 in that diagram. So the world is covered. It's not weighted by size. This is just each individual central bank. But you get the idea that around about the middle of 2022, what you see there is this mass of red, which is saying this is when central banks were really squeezing or throttling the financial system with a liquidity squeeze. What we've had since then is the hues of that chart have changed. They've gone from red increasingly towards orange, or in some cases green. Green means that central banks are easing. Orange means they're still a tad tight. And the sort of yellow color is about a neutral policy. But you get the idea that what we're moving is from extreme tightness towards some ease. Now, the catalyst is, not just falling inflation and slowing economies. It's also a desire by the Chinese to actually deliver a significant economic boost. Now, this chart is basically demonstrating what's going on in China. The black line represents a rolling 90-day sum of, or moving average rather, of liquidity injections into Chinese money markets. There's a very nice V you can see formed on the right-hand side of that chart, with the black line going up very significantly. And the orange line that I put on top of that is a daily nowcast of the Chinese economy. Now, a daily nowcast, for those people that are not familiar, is basically an algorithm that looks at Chinese data releases each day. It compares the outturn of the data releases with what analysts have been projecting. And if you get a positive surprise, that is deemed by the system to be an acceleration in economic growth. And if you get a disappointment on the data release, that's deemed to be a deceleration of economic growth. So when that orange line goes up, it's saying you're getting more data surprises and the economy seems stronger. And it's taken by economists as a pretty good bellwether of the underlying state of the economy or business cycle. So what you can see here is it looks as if the Chinese business cycle is turning upwards. It is following that black line, which has been advanced by 3 months. And it's suggesting that the Chinese economy will see a cyclical pickup. And that's clearly very important. Now, this frames the whole question of China, because what we've seen in the last few months is this sort of general cacophony of noise that's come about saying this is the end of China. You've got structural problems in China. The Chinese system is failing. The Chinese model doesn't work. I mean, you've heard many, many different variants of this. We're getting China is following the Japan model. It's going to collapse. All these sorts of things. I mean, this is complete nonsense. Basically, what has challenged China has been demand, a lack of demand in the system. And I think what you've got to try and understand generally with the Chinese economy, in contrast to the West, is that China is an economy whereby it's still largely state-run. The big industries, the big companies are subsidized by the state. They're not really driving to make profits. They're driving to expand output and employment. And what you've got in that model is that it's very much supply driven, but it's constrained by demand when demand is an issue. Now, it also runs out of resources if you get closed down such as COVID, or you get these supply failures. So effectively what's happened in the case of China is they've been hit, number one, by the fact that the COVID problem, the COVID lockdowns, created a lot of bottlenecks in the supply side of Chinese industry. On top of that, the Chinese were forced to run a very tight monetary policy over the last 3 or 4 years because of the weakness in the Chinese yuan currency. In other words, the counterpart to the strong dollar. And the Chinese wanted to keep the yuan stable against the dollar. So they've basically been tightening policy to keep the yuan up. What has happened in the last few months is they've decided to allow the yuan to weaken, and that has given them an opportunity to basically push a lot of liquidity back into their financial markets to goose the economy. So that's really what's happening. In the case of the West, the different model that the West saw is it also saw a supply shock in the case of COVID, but it actually met that with a huge demand boost. So that's what's happening in the case of these two economies. China has been seeing an output adjustment, whereas the West has been seeing an inflation adjustment. And you've got to think of it in those terms. It's not about the end of China. It's not about a structural problem. It's about a cyclical slowdown, which is now being addressed. So what you're likely to see is a significant cyclical rebound coming in the Chinese economy. And that is significant because clearly what we've got here is evidence that the Chinese are actually injecting lots of liquidity into their money markets.
Yep. Okay, that makes sense. So can I ask, so is all liquidity created equal? And I guess the challenge for China, I don't know if it's China, this might just be looking at debt, but, do we see a diminishing returns of liquidity? The more you put in, maybe you're not seeing the returns that you saw previously.
Well, I think that's generally a point one can make with debt overall. I think that the productivity of debt diminishes with the more debt you have in the system. And I think particularly if you see that debt being channeled into the public sector, it's much more likely to be unproductive debt. So I think the answer to that is very clearly yes. I think in this particular case, we're talking about something a little bit different in the case of China. And I'm not disputing the fact that China also faces these challenges with how does it grow its economy in the medium term? That clearly is a major challenge. But broadly speaking, and I'm not waving a flag for the Chinese system. Don't get me wrong here. What I'm saying is that if you look at how centrally planned economies work, and take the Soviet Union as a very clear example, they tend to be much more supply driven and demand constrained, if you like. And what they need is basically the central bank or whatever it may be to continually boost spending or boost growth or ease liquidity. Now, where you get a problem in a centrally planned economy is that they can keep growing for many years at high rates, but then they suddenly collapse. And we saw that very clearly in Eastern Europe and the Soviet Union. That was very much the model. They did not see a traditional business cycle like you see in the West. And what I'm trying to do is to contrast that. The problem that China has had is it's basically suffering a near-term cyclical demand hit because they decided what they wanted to do was to target the yuan, and therefore policy has been deliberately tightened, and that has caused, if we like, imparted a Western-style cycle into the Chinese economy. And what we're now doing is coming out the other side of that because they're easing monetary policy aggressively.
Okay, that makes sense. And if we can go to I think it's the first slide talking about global liquidity. I don't know if that's the index or
the one that we had before. This
before,
one.
yeah, this the cycle is correct. So if we look at, I guess, the recent, as you said, 10 years, liquidity has been coming down. Yet we've probably seen one of the largest bull markets in history. So I guess from that perspective, what would we expect to see when liquidity continues to rise?
Well, I think what you've got here is that this cycle is basically saying is that this is the growth rate, if you like, or a measure of the growth rate of momentum in liquidity. And what those cycles largely do is to drive asset markets. So as that liquidity cycle picks up, the black line picks up, then what you're going to get is asset markets responding positively or favorably to that. Generally speaking, when that black line's going up, you find asset markets are performing well. When the black line is coming down, you tend to find that asset markets are performing poorly, or they'll correct. And that's really the nature of how liquidity works. Now, if you look at what's going on in the world economy, broadly speaking, what you would expect to see, or what you would look to, I should say, are two things when you're looking at risk assets or understand risk assets. The first one is, what is the flow of liquidity into the markets? So we're saying at the moment it's benign generally. I mean, there may be a small air pocket right now caused by the lack of collateral or falling collateral as the bond markets sell off, but I think that that is limited. What we're really saying is that looking forward, central banks are going to come back and ease a lot more, put a lot more liquidity into the system because they simply have to. Okay, so that's number one. The other thing is inflation. If inflation comes down, that's normally a great heads up for risk assets to perform strongly. Risk asset markets like equities are very sensitive to inflation. They are much less sensitive than many people argue to bond yields, and that's been the sort of the fact that's derailed a lot of analysts who have been saying for a long time, longer than I can remember, that we're about to get an equity correction because the bond markets are selling off. That's never really been the case. What equities respond to is inflation and falling inflation. And there's a chart I can show you to demonstrate the importance of inflation, which is this chart here. And this is trying to demonstrate that inflation is coming down. And what I was arguing earlier on in the context of the different economic models, what you've seen in the case of the West is that you've basically had a double hit. Number one, you've got the supply disruptions because of the COVID crisis, which caused, which was a lack of supply, that bottlenecks and prices rose, often haphazardly, and they were quite volatile and sharp rises. And the other thing is there was an increase in demand because so much money was injected into the systems, money growth shot up, and demand basically was restored. So if you've got a lack of supply and a lot more demand, you're bound to get inflation. Now, what we've got going on right now is that demand is coming down because central banks have tightened, and the supply side has got its act back again together. And so what you're seeing is supplies coming forward. So you're getting this big reduction in inflation. Now, what this chart is basically showing is good news from an equity investor's perspective, because the red line is showing expected inflation according to in the US, according to the University of Michigan survey, their monthly survey. And that has come right down from where it peaked at, this is 1 year ahead inflation expectations, and it peaked at around about 5.5% last year. It's come down now to much lower levels of around sort of just over 3.5. The black dotted line is showing our measure of the pass-through of inflation shocks, and that peaked in late 2021 at around about 32 months. So in other words, what that was saying was that an inflation shock basically would last almost 3 years. So if you've got a jump in inflation this month, it would reverberate through the pricing structure up to 3 years. That was clearly the highest figure that we'd seen since the late 1970s and the big inflation problem that the US had during that period that was ultimately arrested by Volcker coming into the Fed. That's tumbled. So we're now down to about 7 months and it's still falling. So these two measures are telling you that inflation is coming out of the system, and we're moving back, in our view, towards a generally disinflationary world. And if you look at the landscape, and a lot of economies, producer prices are now falling year on year. So all this basically says that inflation is out of the system. If that is correct, a correct judgment, then what you've got is, I think, a very good base for risk assets and equities on a medium-term view. And that's part of our strategy. So we think that those asset classes are good. If you broaden that out and you say, well, okay, let's add in the very fact that central banks have got to undertake a monetary inflation because the debt burden is so large, then what you're talking about is a monetary inflation on top, which means that risk assets like equities, things like precious metals, things like cryptocurrencies are definitely assets that investors want in their portfolios. They do not want bonds. Pancho, what I just said about bonds being okay for the next 12 months, they are on a carry basis, but you've got to face a longer term future of a monetary inflation, which is, I think, highly likely.
That's really interesting. So we're going to see maybe a disconnect of bonds from inflation, and as you said, it's going to be more based on the supply of the actual bonds in the markets, supply
Yeah,
and
I think
demand.
absolutely right. And if you want to throw in your thought about financial repression, that will further, if there is any financial repression, which I think is probably likely anyway, I'm not too sure what shape it would take, but it's likely, then you're going to get a further disconnect between bonds and inflation.
Okay, makes sense. So, Michael, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
I think the message is always is you've got to understand global liquidity and what's happening to global liquidity. That's a key factor. We think that the cycle is turning. Well, in fact, it turned about a year ago. The climb is relatively slow. Let's face that, but it's been sufficient to drive risk asset markets up substantially this year. They've outperformed bond markets. If you look at the next 6 months, I would suggest that bonds are likely to come back into their own a bit. So, it's worth holding some bonds in a portfolio for that carry, virtually risk-free carry. But then, let's think of a year or two halves. The first half of next year may well be less attractive for risk assets as they digest this slower liquidity environment near term. But I think looking beyond that, central banks are going to have to come in. They'll be easing liquidity a lot more. The debt burden or the financing of debt is so significant that they will have to monetize. And that is a fantastic thumbs up for risk assets.
Yeah, makes sense. And when you say, I guess, bonds, are you talking, is there any sort of duration that you're looking at that you think will perform well in the next 6 months?
I wouldn't be an aggressive buyer of duration for the simple reason I think yields have still got upward pressure at maybe the back end of the curve. But I wouldn't dissuade people aggressively from buying 10-year bonds because, as I said, I think on a 12-month view, you could probably at worst break even on a 10-year bond because even if yields backed up, you've got the carry as a cushion. But I would think looking at something nearer the 5-year tenor is probably a much better area to look at.
All right, makes sense. So, yeah, Michael, thanks again for your time. I really appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Best places are probably number one is Capital Wars on Substack that we write 2 or 3 pieces a week on what's happening in markets and global liquidity. Another is occasional tweets on Twitter or X or whatever it's called now, which is the handle is at CrossBorder Cap. And there's our website, which is crossbordercapital.com.
Perfect. I'll put that in the description below, but thanks again for your time.
Great pleasure, Anthony. Thank you.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.